Welcome back to the AlgoBot channel, where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm AlgoBot, and today we're exploring a strategy called the Rogers Satchell Trend Rider. This one is built around a clever piece of statistics, a volatility measurement that ignores trend drift entirely. Over the next few minutes, you'll learn how it estimates market noise from the shape of each candle, how it turns raw momentum into a clean, comparable signal, and exactly how it decides to open and close trades. Everything here is for educational purposes only and never financial advice. So let's get started. Let's start with the big idea, because it's genuinely interesting. Most tools that measure volatility get confused by trends. If price marches steadily in one direction, a close-to-close standard deviation or an average true range reading will swell up and make the market look wild, even when the path is actually quite smooth and orderly. That's a problem, because if you then divide a trend size by that inflated volatility, you end up quieting the very signal you wanted to hear the loudest. The Rogers Satchell Trend Rider works around this using the Rogers Satchell Volatility Estimator. Instead of comparing one bar to the next, it looks purely at the internal geometry of each candle, where the high and low sit relative to the open and the close. By construction, this estimate is drift independent. A steady one-way move does not inflate it. What it captures is the genuine, moment-to-moment noise of the market, cleanly separated from direction. The strategy averages that noise over a chosen window to get a per-bar figure, and then it measures how far price has actually traveled over a recent look back. Dividing the travel by the drift-free noise produces a z-score. You can think of that z-score as answering a simple question. How many units of ordinary, directionless noise is this move worth? For a random, aimless market, that number tends to hover around 1. For a real, committed trend, it pushes well beyond that and stays there, because the noise estimate refuses to inflate and mask it. This is a trend-following approach at heart. It runs on a single time frame, whatever chart you attach it to, and it trades both long and short with equal logic. It's designed for traders who are curious about the statistics of price behavior and who want to study how a volatility-normalized signal behaves across different markets and settings. As always, trading carries real risk, and losses are a normal part of any approach. So treat this as a framework to learn from and test, not a promise of any particular outcome. Now let's walk through the mechanics step by step, exactly as the expert advisor computes them on each newly closed bar. First, the strategy builds its noise estimate. Over a window called VolPeriod, which defaults to 20 bars, it applies the Rogers Satchell formula to each candle. For every bar, it takes the logarithm of the high divided by the close, times the logarithm of the high divided by the open, and adds the logarithm of the low divided by the close times the logarithm of the low divided by the open. Each of those contributions is always 0 or positive. Averaging them and taking the square root gives sigma bar, the drift-free noise per bar. Second, it measures displacement. Using the MomentumLookback setting, which defaults to 10 bars, it takes the logarithm of the current close divided by the close from that many bars ago. That's the recent travel of price, expressed as a log return. Third, it normalizes. Because noise accumulates with the square root of time, it scales sigma bar by the square root of the lookback and divides the displacement by that figure. The result is the z-score. This is the heart of the strategy. Now the rules. For a long, the strategy watches for the z-score to cross upward through the positive entry threshold, which defaults to 1.2, and it also requires the confirming candle to close bullish, meaning the close is above the open. When both are true, it signals a buy. For a short, it's the mirror image. The z-score must cross downward through the negative threshold, and the confirming candle must close bearish. When both align, it signals a sell. Managing the trade uses 2 independent exits. The first is a fade. If price is in a long and the z-score slips back below 0, the normalized trend has dissipated, so the position is closed. The same applies in reverse for a short that sees the z-score rise above 0. The second exit is protective and target-based. The stop-loss is placed a multiple of the average true range away from entry, using the ATR period and stop-ATR multiple settings, and the take-profit sits at a reward-to-risk multiple of that stop distance, controlled by reward ratio, which defaults to 1.8. Whichever event arrives first, the fade, the stop, or the target, decides the outcome of the trade. Let's read through the meta-editor code on screen. At the top are the inputs you can adjust in the strategy tester. VolPeriod sets the Rogers Satchell averaging window at 20 bars. MomentumLookback at 10 is how far back the displacement is measured. EntryThreshold at 1.2 is how many units of drift-free noise the z-score must cross to signal an entry. ATR period and stop ATR multiple shape the stop distance, and reward ratio sets the take profit as a multiple of that stop. Lots fixes the position size, and magic tags the orders. Below the inputs, for booleans do the decision-making. Cross-up is true when the previous z-score was at or below the threshold and the current one has moved above it. Cross-down is the mirror for a downward cross of the negative threshold. Bull and bear simply check whether the confirming candle closed above or below its open. Now the long block. When cross-up and bull are both true, the code reads the ask price as the entry, sets the stop-loss one stop distance below it, and places the take profit at the entry plus the stop distance times the reward ratio. Then it calls trade.buy with those levels attached. The short block is the exact reverse. When cross-down and bear are both true, it reads the bid price, sets the stop-loss above the entry, places the take profit below by the reward multiple, and calls trade.sell. Notice both sides share identical structure, just flipped in direction. That symmetry is what lets the strategy respond to trends whichever way the market leans. Let's bring the whole strategy to life on this illustration. Across the top you can see the price candles, and in the panel below is the star of the show, the volatility-normalized z-score. Notice the three dashed guides in that panel, a green line at positive 1.2, a gray zero line in the middle, and a red line at negative 1.2. Those upper and lower guides are the entry thresholds, and the shaded bands mark where the market is behaving like a genuine trend rather than random noise. Watch the opening candles. Price drifts sideways and slightly lower, and the z-score wanders quietly between the guides, sitting near zero and even dipping a little negative. This is exactly the random walk behavior the strategy expects most of the time. There's no committed direction, so the z-score has no reason to stray far from the middle, and the strategy simply waits. Patience is built in. Then the character changes. On the fourth candle, price pushes up with a strong bullish body, closing well above its open. In the panel below, the z-score climbs and crosses cleanly upward through the green positive threshold. That's the exact condition the strategy is looking for. The recent move is now worth far more than ordinary drift-free noise, and the confirming candle closed bullish. Both requirements line up, and the buy entry marker appears. The stop-loss is tucked a couple of average true-range multiples below the entry, giving the trade room to breathe, and the take profit is projected upward at the reward-to-risk multiple of 1.8. From there, the trend does the work. The next candles continue higher, each one building on the last, and the z-score stays lifted inside the upper band. Because the noise estimate refuses to inflate with the drift, the signal stays loud and clear instead of fading. Price reaches the take profit target at the seventh candle, and the long trade closes in the green. This is the ideal case the strategy is designed to capture, a clean, persistent push that the z-score confirmed early and rode to target. Now watch the market roll over. On the eighth candle, price stalls at the top and prints a reversal, and the z-score begins sliding down out of the upper band. It passes back through the zero line, which tells us the earlier upward pressure has fully dissipated. The strategy is now neutral again, watching for the next committed move in either direction. That move arrives on the 10th candle, and this time it's to the downside. Price drops with a firm, bearish body, closing below its open, and in the panel the z-score crosses downward through the red negative threshold. Again, both conditions agree. The normalized move is significantly larger than noise, and the candle closed bearish, so the sell entry marker appears. Here the stop-loss sits above the entry and the take profit is projected downward, mirroring the long exactly. The downtrend then extends candle by candle, the z-score holding inside the lower band, and price glides down to reach the take profit target on the final candle. Both trades in this illustration followed the same disciplined recipe. Wait through the noise, act only on a confirmed threshold crossing, and let the drift-independent z-score decide when the move is real. Of course, not every setup resolves this cleanly. In live conditions, some trades will reach the stop loss instead, and that is a normal, expected part of any trend-following approach. And that's the Rogers Satchell Trend Rider. Today we saw how it estimates market noise from the geometry of each candle in a way that ignores trend drift, how it turns recent price travel into a clean Z-score, and how it enters on confirmed threshold crossings while managing trades with a zero-line fade, an average true-range stop, and a reward-based target. Remember, this video is educational content only and not financial advice, a recommendation, or a solicitation to trade. Every strategy carries real risk, so always study, test, and reflect before making any decisions. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and drop a comment with the strategy you'd like us to explore next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.